In 1972, people didn't blow up their portfolios because they bought terrible companies. They bought the best companies, the safe ones, the ones everyone trusted. And that's the trap, because the real danger wasn't the businesses, it was the expectations. The market started paying any price for quality, and then one day it stopped. Not because the companies suddenly became trash. When perfection cracked, leaders don't drift down, they reprice. So here's the uncomfortable question for today. Are we doing a 1972 trade again, only this time the leader has a different logo? Because NVIDIA might be an incredible company with a real moat and still be a dangerous stock if the expectations are too perfect. Quick disclaimer before we go further. This is educational content, not financial advice. Now let us talk about NVIDIA like a business, not like a ticker. Because if you cannot explain what you own in plain English, you are not investing. You are just hoping the chart keeps going up. So what is NVIDIA really? The quick answer is, NVIDIA sells the compute engines that power modern AI. But the more useful answer is, NVIDIA has spent decades building an entire stack. Chips, networking, software, and developer tools, all designed to make parallel computing easy, fast, and scalable. The chip gets the headline. The platform is the reason the headline keeps repeating. Here's the chip story, without the jargon. A CPU is like a small group of very smart workers doing tasks, one after another. A GPU is like a massive team doing lots of smaller tasks at the same time. That is perfect for graphics, and it is also perfect for training neural networks, because training is basically giant math that you want to do in parallel. NVIDIA leaned into that early. They did not stay a gaming graphics company. They built data center-grade GPUs and platforms designed for workloads that businesses actually care about. Over time, the product stopped being a single chip. It became the engine room. And then there is the word you hear everywhere, CUDA. This is where most people get it wrong. They think NVIDIA's moat is just speed, like the chips are faster. Sure, but chips get copied. Ecosystems do not. CUDA is NVIDIA's software ecosystem that makes it easier for developers to program GPUs, optimize performance, and ship real products. And once teams build their tools, libraries, workflows, and talent around one ecosystem, switching is not a casual decision. It is rewriting. It is retraining. It is risk. It is deadlines. It is if this breaks, my career breaks. That is why NVIDIA's leadership has been sticky. Not only because it is fast, but because it is familiar, compatible, and deployable. That is what people mean when they say moat. It is not one wall. It is layers. Now zoom out again, because NVIDIA does not just sell chips and software. They have been moving up the stack into systems. Think about the buyer. The big cloud companies and enterprises are not trying to collect GPUs like trading cards. They are trying to build reliable, scalable systems that can train and run models in the real world. NVIDIA increasingly sells integrated solutions, clusters, reference architectures, and AI factory-style setups that take you from hardware to a working system faster. And in the real world, speed to deploy is a competitive advantage. There is also a layer most investors ignore until it becomes the bottleneck: networking. Inside an AI cluster, moving data around becomes a limiter. The faster your GPUs get, the more you care about the plumbing between them. NVIDIA's networking and interconnect technology helps turn a pile of GPUs into one coherent machine. That is why the story is platform, not product. But here's the part you cannot ignore if you remember 1972. Foundational does not mean unlimited. Demand is tied to a cycle, the AI capital spending cycle. When budgets are expanding, demand surges. When budgets tighten, demand pauses. When the next wave shifts from massive training to efficiency and inference, the mix changes. NVIDIA can still win, and the stock can still get hit, because markets don't only punish negative growth. Markets punish a change in slope. Leaders don't have to fail to fall. They just have to disappoint perfection. So if you want to understand NVIDIA as a business, stop staring at the chart and track the drivers. Watch data center revenue and the pace of hyperscaler spending, because a handful of mega customers can swing quarters. Watch supply constraints and product transitions, because launches can pull demand forward and digestion can follow. Watch competition, not just from AMD and Intel, but from custom silicon and in-house chips designed by NVIDIA's own customers. Watch pricing power and margins, because leaders earn premium economics until customers push back or alternatives mature. Now let's connect this directly to 1972. Back then, the leaders were leaders because of distribution, brand, and scale. Their moats were physical and psychological. NVIDIA's moat is technological and ecosystem-based. That can be stronger in some ways, because ecosystems create real lock-in. It can also be weaker in other ways, because technology cycles move fast, and big customers can turn into competitors. So what is the strongest bull case? AI is a multi-decade shift. Compute demand keeps compounding. NVIDIA's platform is ahead, and even with competition, the market grows so fast that NVIDIA grows into the valuation. And what is the strongest bear case? AI demand is real but lumpy. Margins normalize as competition and custom silicon grow. Geopolitical constraints cap parts of the market, and the stock is priced as if execution stays perfect for a very long time. Here is the key. Both can be partly true. AI can be real and NVIDIA can still be volatile. NVIDIA can win and the multiple can still compress. The job is separating the business trajectory from the expectation trajectory. So what does a healthy leader look like? A healthy leader is when earnings growth does most of the work, not hype and multiple expansion. It is when the ecosystem broadens and demand becomes less dependent on a tiny group of mega buyers. It is when the story is backed by a wide base of real spending, not just pull forward. And what does an unhealthy leader look like? It is when valuation does most of the lifting, when positioning gets one-sided, when the stock moves on vibes more than numbers. It is when the company becomes a proxy for the entire theme, so every macro headline hits it like a currency. That is when the best company can become the most fragile stock, because perfection has no margin for error. So here's your practical takeaway. If you want to tell whether NVIDIA is acting like a healthy leader or a 1972 setup, keep your eye on a small set of signals: relative strength versus the index, market breadth, and changes in earnings expectations and guidance tone. That is where the market quietly rewrites the story before the headlines catch up. In the next episode, we will connect NVIDIA's story to valuation and expectations without turning it into a spreadsheet competition. We will talk about what it means to pay for growth when the discount rate changes, and why 1972 is the cautionary tale behind quality at any price. Before you go, I want you to comment one thing you think people misunderstand about NVIDIA. Is it the tech, the competition, the customers, or the valuation? I read those and they tell me what the market is missing. And one last reminder, NVIDIA is not only a data center company. Gaming has historically funded research and development, built brand, and trained the company to ship at scale. Over time, areas like professional visualization, automotive, and edge can matter too. Even if data center is the main engine, these segments shape resilience across cycles. In 1972 terms, it is the difference between a single product story and a platform story. But even platform stories can hit demand cliffs when customers digest inventory or when spending pauses. That is the part the market never prices in, until it does.